Hi everybody and welcome to our second revision webinar focusing on some A2 microeconomics. And in this session we're going to be thinking about some questions relating to business profits. All sorts of scope for great multiple choice questions and things on this area. So let's get cracking. Keep in mind if you're a regular visitor to the webinars that all of our webinars are recorded and put on our YouTube channel. And you can also find me on Twitter at TutorToYouJeff if you want to ask individual revision questions. There's hundreds of revision videos up there now covering all kinds of different topics. It'd be great if you could have a look at one or two that might be helpful to you. Here's our first question to have a go at. If you're watching the recorded version of this webinar, take a few moments to read the question through. You can always press the pause button and then have a go at the answer before I reveal it. Here's our first question. When does a firm maximize profits? When does a firm maximize profits? What do you think the answer is? And the answer is C. Firm maximizes profits when marginal profit is zero. Let's look at some of the other answers. Option A, when average revenue equals average cost, is the condition for a firm making normal profit, not necessarily maximum profit. B, when marginal revenue is zero, that's the condition for when a firm is aiming to maximize their revenue. Not quite the same as profit. C is right, sorry. D is wrong. Average cost minimized, well, that's the output of productive efficiency. And again, that's not necessarily, in fact rarely, the output where you maximize profit. The answer is, it's when marginal profit is zero. Now let's just have a little look at this in more detail. So marginal profit for business is the increase or the change in profit when one more unit is sold. So in this area here, this output here, let's say the marginal revenue is £50 and the marginal cost is, let's say, 10. So you're adding £40 to profit by making that unit. Whereas if we expand output right across to here, now the marginal cost is greater than the marginal revenue. Let's say the marginal cost is 60 and the marginal revenue is, let's say, 25. 60 and 25, well, you'd be losing £35 of profit if you were to produce that output. So profits are rising when marginal profit is positive, profits are falling when marginal profit is negative. So you maximize profits when marginal revenue equals marginal cost. Second question. What effect will a fall in a firm's fixed costs have on their profit maximizing price and profit? What effect will a fall in a firm's fixed costs have on profit maximizing price and profit? Have a think about that question. Okay, well, the answer to this question is C. There's no change in the profit maximizing price. Total profits will be up. A lot of students would put B to this. They would think the price would fall and profits would go up. No, the price will stay the same. Let's have a look at the thinking behind it. Here's an initial situation where a firm is maximising profits at output Q1. They're charging a price P1 and the average cost is about C1. Now, that's the supernormal profit. Actually, at the price P1, they're making a supernormal return. If the firm's fixed costs go down, can you see what's happened here? The average cost has fallen. But there's been no change in marginal cost because marginal cost is only affected by variable cost of production, not by fixed costs. So the average cost has fallen, still cuts marginal at minimum point. They can still charge P1. There's no change in the profit maximizing price, but now the cost is lower, C2. As a result, profits are higher because, of course, the cost per unit is just lower than it was before. Let's look at that again. Cost before, cost after. The yellow area is bigger. The total profits are up. So a fall in fixed costs has no effect on price but does increase the total profit of the business. Here's question 3. Which one of the following is most likely to increase the total profits of a business in a contestable market? Which one of the following is most likely to increase the total profits of a business in a contestable market? Press the pause button if you want to think about your answer. And the answer to this question is D. Well, let's work through it. The entry of new firms, of course, will possibly compete away the profits of existing firms. Likewise, a price cap set by an industry regulator is likely to be set below the normal profit maximising price, and again would likely to be diminishing the total profits. And C, if rival firms increase their output capacity and in other words sell more and lower their prices, then that could squeeze the profits made by a business. In other words, if all firms increase their output, and that will drive prices down in the market and drive down profits. Price discrimination can often be an effective strategy for businesses to increase their revenues and their profits. We'll do a separate video on price discrimination, but it's a classic example of how businesses charge a different price to different groups of consumers for what's essentially the same product. Hairdressing discounts, off-peak and peak prices for mobile phone contracts, Uber increasing their fares a couple of days ago during the London tube strike, etc. Question 4. If a business is making normal profit, it must be true that. Press the pause button if you want to think through your answer before I reveal. If a business is making normal profit, it must be true that. What did you put for your answer? The correct answer is A. Average cost equals average revenue. Yes, that's the definition of normal profit, when the unit cost of production equals the price per unit. We actually include the normal profit in the average cost of a business. And our fifth question in this little revision session on business costs. The table below shows the cost and revenue information for a business. Within which of the following output ranges will profits be maximised? Within which of the following output ranges will profits be maximised? Again, press the pause button if you want to think this one through or do some number crunching, and I'll reveal the answer for you in a second. And the answer to this question is B, between the third and the fourth ton. Here's the explanation. You've got some information on output going up in units of tons there, going up by 1 tonne per unit. Revenue is rising by £20 per tonne. This tells you this is a firm actually operating in perfect competition. Every tonne of output beyond 2, the marginal revenue is 20. So of course you're looking for profit maximisation, and profit maximisation happens when marginal cost equals marginal revenue. The fourth tonne adds £20 to revenue and cost. So we will produce the fourth tonne, so the profits are maximised between the third and the fourth tonne of output. The answer is B. The fifth tonne of output, well, we get £20 of revenue, but it costs us 25 to supply, so our profits will be falling by 5. One of the issues, I think, is that companies make profits, some businesses make losses. It's quite interesting to think about the factors that affect the profitability of a business, both in the short term and in the long term. And the reality is that there are many, many factors that affect profitability. Here's a business, PepsiCo, that makes serious money. It's one of the biggest businesses in the world. Profitability fell post-crisis, post-recession into 2010. But actually in recent years, Pepsi has made a pretty stable, pretty consistent operating profit of about 14%. In other words, for every dollar of revenue, 14% has been profit. It's pretty impressive. And in the webinar, I've asked the participants who've been involved live to type into the chat window an example of a factor they think affects profits of Pepsi in the short run, for example, 6 months to a year, and a factor that affects the profits or the profitability of Pepsi in the long run. This is quite an interesting dynamic, and in the webinar we got some tremendous answers. Short run factors, long run factors affecting profitability. Here are some suggestions for those of you using the webinar and the YouTube video to write some extra notes. So there are many factors affecting profits. This is the Pepsi factory in Russia, the Pepsi factory, I suppose we should call it. So short-term factors tend to be factors over which Pepsi has little control, essentially. The world price of aluminium, for example, the cost of the input used in making the tin cans, the price of plastics, the price of logistics, transport costs, fuel and energy, that kind of stuff. So input prices are short-term factors which Pepsi can have some degree of influence over, but not much. Pepsi doesn't set, for example, the world price of aluminium. Short-term factor could be a change in a tax, a change in a carbon tax, for example, or the introduction of a tax on consumption, the new sugar tax that's coming into the UK. Productivity, the efficiency of workers can change from year to year, and that can be a short-term factor affecting their unit costs. So too is the strength of demand in the market. So depending in part on the income elasticity, Pepsi's sales will rise and fall with the economic cycle, perhaps, the strength of cyclical demand. And a really key point, particularly those of you who are hoping to become more synoptic economists and see the connections between micro and macro and macro and micro, is to think about, for example, the impact of the exchange rate on a business such as Pepsi. To what extent, for example, is the strong dollar going to hit Pepsi's overseas sales in the next 3 or 4 years? Or will Pepsi be able to avoid that kind of effect by producing and selling most of its products outside of the States, and therefore largely bypassing the effects of the strong dollar? So these are some of the short-term cyclical factors affecting profits. And then the long run is really thinking about more sort of fundamental, if you like, what's the word here? More sort of structural factors affecting cost and revenue and demand. So economies of scale will be important to Pepsi. Clearly, they produce 1.2 trillion gallons of liquid a year. Scale economy is important. Come back to a diagram of that in a second. Behavioural change is important. Again, maybe bring some behavioural economics in. To what extent is Pepsi having to adjust and adapt to subtle behavioural changes in people's preferences about the sort of products they consume? Pepsi has been around for decades, but you have to reinvent the wheel. So Pepsi Max, Diet Pepsi, sugar-free Pepsi, I don't know, protein Pepsi, whatever it is, the extent to which Pepsi successfully diversifies the Pepsi brand and brings new brands into play. Gatorade, Aquafina, etc. Great opportunity to think about the long-term effects, for good or bad, about takeovers and mergers. So Pepsi is a very vertically integrated company. It's bought some bottling plants. It's bought some retail investments, etc. The extent to which Pepsi can use its vertical integration to sustain profits. And fundamentally, and very importantly, the strength of competition, both actual and potential. The extent, for example, at the moment to which Pepsi is having to fight the rise of pretty aggressive marketing companies like Red Bull, and also the rise of the smoothie makers and the protein drinks and the intense competition in the kind of sports drinks industries. So the strength of market competition may be a long-term factor, constraining, impacting on their profitability. I just think this is really interesting economics, because a company like Pepsi is almost guaranteed to make money, 15% on the dollar, but the profits will rise and fall as the economic factors change in the short term and the long term. Quick diagram to finish this webinar. We talked about scale economies in our revision webinar on cost. Just wanted to show you this really, really good diagram showing how scale economies affect profits. So initially, in the short term, the firm is profit maximising at an output of Q1, and it's producing Q1 and can sell at P1 using the demand curve. There's the unit cost C1, some nice profit there. Now, if you can achieve some scale economies, you can move on to lower cost curves. MC2, AC2 are lower cost curves. Increased output, lower costs. And I'm assuming the demand stays the same. It just makes life a little easier with the diagram. But now, here we go. now we can maximise profits at a much higher output Q2. As MR now cuts MC here. Our prices come down, P2, good news for consumers, but the unit cost is so much lower because of the scale economies. And the result is that you can make a substantial amount of profit. So scale economies means firms can reduce their prices and make more money. Let me just tweak the diagram here. That was the profit before, profit before, profit after. Yellow area is clearly bigger than the green area, as this graphic now shows. So scale economies can increase the output of a firm, bring down the unit cost, and increase the profitability of a business. And for the likes of PepsiCo and Coca-Cola and others, scale does matter. It's a key long-term factor affecting profits. Those of you using the webinar version of this, the YouTube version of this webinar, will want some definitions and things. So here's my definition slide. Some key definitions there. If you need it, just press the pause button and jot them down. Okay. A reminder that this webinar and our weekly economics webinars are available for live viewing on the night and for viewing on YouTube, our YouTube channel, later on. So if you are using our YouTube channel to look at this, thanks for joining in, and maybe check out some more of our hundreds of economics videos online at the moment. But for the moment, thank you for joining in, and see you again sometime soon.